Basically, remember that we were discussing on government security portfolio with you all, especially the treasury bonds under issue management. There we have discussed with you treasury bill and treasury bonds with you all. So treasury bill pricing we have learned straightforward, and treasury bond, of course, we have learned how do you do the pricing. Remember, the special thing is to learn treasury bonds. With regard to treasury bonds, you take cash flow, is 0, 1, 2, 3, 4 lines, right? Then you have what coupon interest here, coupon interest you have. Then you have maturity, end of the period you have maturity. Then you add this, and you have figures here, and you do what? You basically do discounting, right? You bring it to today's term. Today's term in the sense, here is 0. Bring it here 0. Here and here. So that once you get this, once you get this, so basically you will be multiplying this particular amount, present value, present value, present value, present value, multiply, multiply, multiply. Then you have figures, you have figures, you have figures, you have figures. Once you add these figures, final answer is your pricing of the particular treasury bond. Pricing of your treasury bond. Right? Pricing of your treasury bond. So we learn treasury bond can be either premium, discount, or nominal value. Now in Sri Lanka, we have learned nominal value of a treasury bill, treasury bond is rupees 100. So always we take as maturity amount 100. Right? Always we take maturity amount as 100. And you do the discounting. How do you find out the discounting factor here? This one. Your required rate of return. So when you come to project appraisal, we will be learning how to calculate the required rate of return. And for the time being, the individual to take that now by investing in this particular instrument, how much I can earn as yield percentage. So if I don't do investment here, so what are the alternative investments I have? For example, I can invest my money in FD. So FD gives me, example, 1 year or 5 year, 10% or 12%. If I want to invest this particular treasury bond, I need more than that. So that is your choice. We say 12%. 12% is your discounting factor. So you do the discounting by using discounting factor. We learn a formula. Remember, 1 divided by 1 plus r to the power. That's the formula you have to use in the exam. Examiner is not giving that particular formula to you. You have to keep in mind. And we have learned a method keeping that in your calculator and divided by the same particular percentage, discounting percentage. We have done several questions with you. Later on we will do some more questions, and please go through the previous notes as well. Now what I want to recall our memories to the previous lecture, and if you can remember this particular one, this is the particular one we want to learn. This one, straightforward for the calculation of I'm sorry, 1 second. Straightforward calculation, treasury bill. Now we wanted to remember that we discussed the yield and the price, and this is the questions we did it in the class. Only thing, if the coupon is paid differently. Now here we have taken 1 year. In this particular question, we have taken 1 year. So then you don't know do anything. Now, if you take this particular example, which we did it in the class, here the second question: how much should an investor pay to buy 100 coupon 18 2-year bond pays semi-annual? So the 2 year, but interest or the coupon is paid semi-annually. So the how many periods per year? 2. Then 2 years, how many? 4. How many periods? 1, 2, 3, 4. Remember that we did it in the class. Only thing, investor required rate of return 22, but it is annual. Now we are taking semi-annual. Of course, we took 11% as a discounting factor, right? We did it, and we wanted to do this. What is this dirty price? Clean price. Remember that. Now listen to this carefully. Right? Listen to this carefully. Now see. Now for example, okay, there is a bond coupon 10%. Maturity, we say 2025 January 20th. Maturity. So we are going to purchase this particular instrument today. We call it, remember, settlement date. Sekai September 2nd. You can have other instruments. Fine. Now, features of this particular instrument. Remember, did it in the class. Features of a treasury bond. If you can remember, this. This is the feature. Now see, this is the coupon. This is a series. Now here the coupon. Coupon is now see, coupon rate is 6.3% per annum. But generally, how does the treasury bond pays coupon? Generally semi-annual. Government securities, anyway it's semi-annual. There is no any other way. But if you take it debentures, if you take other things like corporate bonds, it can be either. Now depending if you see now, if your bank issuance of debenture, interest or the coupon can be paid monthly if you want. If your bank needs, if your bank needs, the coupon can be paid quarterly, monthly, annually. Can be either. But with regard to the government securities, remember the word government security. Instrument issued by the government. Instrument issued by the Central Bank of Sri Lanka on behalf of the government. Coupon has to be semi-annual anyway. There is no any other option. Right now, see, coupon rate. Issue date is this. Maturity is this. Now, coupon is payment. May, November, semi-annual. January, July. January 1, July after 6 months. May 5 year month of May, number is 5 first month, so the after 6 months number, so our decay like that. Now take this example. All the features here similar to the pressure bone advertisement. Now you're going to purchase this particular bond. When you purchase. Now tell me, this is the government security. What are the two coupon dates? Why I said two? We know coupon is anyway paid semi-annually. Coupon is anyway paid semi-annually. So if somebody comes and asks how the coupon is paid for the instrument of government security, treasury bonds, it's always semi-annual. It's always semi-annual, right? So remember in the exam, if the examiner does not give anything on the coupon payment, if the examiner gives you maturity date, now even the maturity date is not given by the examiner. There was a way we learned to find it. How? By looking at the ISIN, International Security Identification Number, gives the maturity date. Remember LKB for treasury bond, LKA for treasury bill, advertisement is available, right? We did it in the class and denoted by which one, which one. The English letter is the month. So the left hand side, day, the right hand side, the year of the maturity. So everything is given. Even the examiner does not give the maturity date particularly. You can find it out by using the ISIN, International Security Identification Number. So remember, now this is the maturity date is given. Now you are going to purchase this particular treasury bond today. Now my question is, when is the coupon date? Coupon date is not given. These are the only three features, only three criteria given by the examiner. It's the only thing we have been given. Settlement date is the purchase date. Today we are purchasing. This is the maturity date. So the 4-year treasury bond. 4-year treasury bond. 4-year treasury bond. Coupon is 10%. No need to say this is semi-annual. Why? This is the government security. G6. Coupon is always semi-annual. There is no alternative. Now say I'm going to purchase this particular bond today. Somebody was holding this previously. It doesn't matter. He is willing to sell, so I'm willing to buy. Everything is matched. My buying price is matched with his selling price. So that's the transaction is happened, right? You want to sell anything, you want to match. I'm selling at this price. If you like, you purchase for my price. Otherwise, we can bargain. Both the people have to come to one conclusion price. Then only transaction would happen. Now my question is, even you are not given semi-annual, it's understood. My question is, when is the two coupon payments date? Only thing remember in the exam, very important thing, is on the maturity date, you are getting one coupon. Right? On the maturity date, you are getting one coupon. That is important. On the maturity date, you are getting one coupon. When is the maturity? When is the maturity? On the maturity date, you are getting one coupon. So the coupon payment. One is when? January 20th. When? What is the year? 2025, 2026 January, you are getting one. 2027 January, I'm sorry, 2022. Now you're purchasing it today. So the 2022 first coupon you are getting it. 2020. I'm talking about the January. 2022 you are get January you are getting another coupon. 2023 January 20th you are getting another coupon. 2024 you are getting another coupon. 2025 January 20th you are getting another coupon. So basically on the maturity date you are getting one coupon. When is the maturity date? January 20th 2025. Forget about the year. We need the day and the month. You are getting a one particular coupon in the month of January. Two coupon payments are two coupon payments are due per year. One is paid in January, paid by 6 month time, semi-annually. When is the next coupon? එක කූපන් එකක් ජනවාරි ගෙවනවා නම් අවුරුද්දට කූපන් දෙක නම් කූපන් ගෙවන්නේ semi-annual නම් මාස 6කට සැරයක් නම්. If one coupon payment is done in January, when is the next? Obviously July, after 6 month time. January 20th, February, March, April, May, June, July. So the next coupon is when? July 20th. Simple. Anything like that. Now if you go to this particular one. Now see, when is the maturity date? 15 November 2023. Forget about the year. 15 November. So the one coupon should be received 15 November. Per year, two coupon. Semi-annual. When is the next 6 months? එකක් November නම් අනිත් එක obviously May. When is the maturity date? July. One coupon gets the people the person who is holding this particular security, he gets one coupon on the 1st of July every year until it gets matured. So you're getting one coupon, one 6 month coupon July. When is the next? අවුරුද්දට දෙපාරයි. එකක් හම්බ වෙනවා July. July වලට ගියාට පස්සේ අනිත් එක හම්බ වෙන්නේ when? January. මාස 6කට පස්සේ. අවුරුද්දට දෙකයි. එකක් January අනිත් එක July. That is how you find out. That's how it says date of coupon payment. You don't examine it, not necessarily should give this. You can find it out. You can find it out. If you are given ISIN number, you can find the date of the maturity. If you find the date of the maturity, you can find the coupon payment as well. So on the maturity date, you are getting one coupon. So if it is semi-annual, you get the other one. Annual is twice. Annually, you get twice. Understood? That part you can understand, right? Somebody was holding this particular bond till 2021 September 2nd, till yesterday. Now I'm going to purchase this particular bond today. Somebody was holding this particular bond, seller. Somebody is holding, he wants to sell. Now he's selling me, I'm the buyer. Was holding this particular bond until 2021 September 1st, till yesterday. I'm purchasing this bond. I have purchased. Now example, prices also, everything is okay for us. We have purchased this particular bond. Now this bond is mine. Why? Today is 2nd, I have purchased this bond. Now this particular bond is mine now. Okay, I have. It is an asset for me. I paid, I received this security. Okay, understood. I'm holding this particular bond. I'm holding. This month is September. I'm holding this particular bond October. I'm holding this particular bond November. I'm holding this particular bond December. January comes. I know January there is a one coupon is due. When? 20th January. Now today, hypothetically say 2022 January 20th, today, I should receive a coupon. Coupon amount should be credited to my account. How much the coupon I should receive? We take one particular unit. Particular unit is 100. I always told you, coupon is paid on the face value, not on the invested amount. It doesn't matter. You can invest now. Say if this is a one particular one, you can pay 90 rupees to purchase this particular one. You can pay 120 rupees to purchase this, but it doesn't matter. But coupon is paid based on the 100. Whatever the amount you pay in material for you to get or for you to calculate coupon. Coupon is always paid on face value. Face value in Sri Lanka, or the nominal value, and the face value here is same. Face value of particular instrument in Sri Lanka is always we take as 100, like nominal value. 100, coupon is 10%. This is annual. Semi-annual I am getting of 5 rupees. I should get. I have purchased this particular bond today. Now today is assuming 2022 January 20. What's the speciality of 2022 January 20? I should receive a coupon interest. Semi-annual coupon interest I should receive. Why should I receive? I have purchased this particular bond last September. Today is January 20th, 2022, right? So I'm expecting, I'm viewing my account, whether the central bank has credited to my account 5 rupees. My coupon is 5 rupees. Coupon is 5 rupees. As you very correctly thought, central bank has credited 5 rupees. We are talking about the one unit. We have purchased only one unit. रुपया 100 කියලා හිතනවා. रुपया 100ක් වේදන් කරලා දැන් මම ගත්තේ. 100ක බොන්ඩ් එකක් තමයි මම ගත්තේ. So I have a face value of 100. So I should receive, my account should be credited with rupees 5. Account has been credited, paying coupon interest for my government security treasury bond. You can enjoy with this 5 rupees. What is this 5 rupees? 6-month coupon interest. Are you happy or not? You have to buy. Get 5 rupees for 6 months. My question is, were you holding for 6 months to get this 5 rupees? Well, make a whole crowd the 6 months for you to get 5 rupees. 5 rupees is 6 month coupon. Did you hold this 6 months? When did you purchase this? September 2nd. September 2nd. October 2nd වලට මාසයයි. November 2nd. December 2nd. January 2nd වලට 4 months. 4 months plus 18 days roughly. I have been holding this particular instrument 4 months and 18 days. But central bank has credited to my account entire 6 months coupon. Is it right or wrong? It's wrong. But that's how the system works. That's how the system works. Central bank is not worrying about how long you have been holding this particular bond. From the seller side and the buyer side. You check the list of holders, it says your name is appearing. So the entire coupon amount is credited to you. For the new purchaser has not been held. He was not holding this particular instrument for 6 months. It was only I have been holding this particular instrument only 4 months plus 18 days. But central bank has credited 6 months. So then I have to pay what? The amount which is not entitled for me to entertain. Do you pay that? I don't think anybody will pay that. I don't think that. Once you receive by investing anything, yeah, I don't think that some people will pay, but I the majority will not. Majority will not pay. Central bank also knows that. So then, how do you rectify this error? Which part is not relevant to you? Shall you calculate that? From the last coupon date to the settlement date. When is the last coupon date? Now, this seller was holding this particular instrument till 2021 September 1st. September 2nd only I purchased. Until September 1st, he was holding. So when was the last coupon date for him? January is January. September now. We are in September. What is the last coupon date? January or July? Obviously, July. July 20th. This guy has received one coupon. From July 2nd, sorry, from July 20th to the settlement date, this guy was holding this particular instrument. So basically, any amount I should receive after September only. So my return should be only 4 months and 18 days. So my money has been invested only on September 2nd. So the anything I should receive based on the return of this particular investment should be from September 2nd. It's only 4 months and 18 days. September එක October November December January මාස 4යි. January 2ට මාස 4යි. So then we have another 18 days. That's how I calculated 4 months and 18 months comes like that, right? From July to September, this seller must be paid how much? 10, I'm sorry, 100, 10%. Generally, we take for bonds actual to actual. So 2021, it's 365. How many days? From July 20 to September 2nd. Exact number of days. July is July 20th of July, 8. So the 1 year, one month comes 8/20, and the 9/20 second month. But 9 came here. Only 12 days, right? 1 month and 12 days. So the 1 month and 12 days. So the July, so you have 30, exact number of days you should calculate, right? 30 plus 12 days. So basically 42. So 100, so which is the face value, 10% is the coupon, and not entitled amount is 365, 42 divided by 365. It is not entitled to you, to me. Why? I have purchased this particular bond from 2021 September. This particular amount we call it what? Accrued interest. Accrued interest is what? The coupon interest which is not entitled to the new purchaser. Accrued interest which is not entitled to the new purchaser. So when you calculate the pricing of government security, especially the treasury bond, the price we get is dirty price, including accrued interest part as well. Now, when you calculate the pricing of this particular instrument, it includes the accrued interest part as well. Meaning is what? Now you are going to purchase this particular instrument on the 2nd of September. So when we calculate the pricing, for example, we say it comes 90, 90, 90, 98, example, right? Example, 98 rupees. So for you to acquire this one particular unit, you pay 98. So this particular instrument is trading at discount below 100, 90. So what I want to tell you is, if the seller says, I am willing to sell this particular instrument at 98, meaning is what? It includes the accrued interest part as well. It is entitled to whom? The seller. Which includes the accrued interest part as well in this particular pricing. So when I determine the pricing of this particular instrument, everything is included in this pricing. Anything I will be receiving on the next coupon date, which is not entitled to me, with the amount which I have to pay to the seller, also includes when you do the pricing of this particular. 98 includes accrued interest part as well. So it means what? When you pay to the seller, you pay this particular amount with this accrued interest part. Otherwise, what you should have do is, if this accrued interest part does not include here, once you receive this entire 5 rupees, you have to pay whatever the accrued interest part which is not entitled to you after your account is credited with this 5 rupees. You calculate the what is the which one is how much the portion out of this 5 rupees not entitled to you, then you pay back to the seller. Then you have to find out who is the seller, where is he, what is his account number, everything. You won't do that. Central bank knows it. Central bank has instructed to include everything which entitles the seller in the pricing. So that entire 5 rupees, even you get entire 5 rupees to account, you don't have to worry about, you don't have to pay anything to the seller. Why? You have already paid where? When you determine the pricing. Understood? That's how this mechanism is happening. So dirty price means what? Clean price minus accrued interest. Now, when you calculate, when you in the exam, when you ask to calculate the bond pricing, it comes with it is basically the dirty price. The examiner asks you to find out the clean price. First, you calculate the dirty price, like you do normal calculation, pricing, cash flows. Then you do the discounting, and you calculate the dirty price. Then you have to find out the specifically, separately, you have to find out what? Accrued interest part. Then you do what? Dirty price means clean price plus accrued interest. So when you're asked to calculate the pricing of this particular instrument, you get dirty price. Then when you specifically calculate the accrued interest, obviously there are three variables in this particular formula. One, two, three. Then you have two, dirty price you know, and the clean accrued price also you know. Then when the examiner asks you to find out the clean price, you can do that. The examiner asks you straight away to find out the clean price, you can't do that. Basically, the answer you get is dirty price. Then you have to find out the accrued interest. Then you do the necessary calculation for you to find clean price. And now now understand this. This is the advertisement which we gave it to you in the first lecture, and it says accrued interest. Now, if we are seeing why this 100 comes, face value is anyway 100. We calculate the coupon based on the particular amount. This is the 1 unit face value. So face value is maybe different depending on the amount you invest, but we generally for the convenient purpose we take 1 unit price as 100. Based on 100 we calculate the old coupon rate, and the accrued price is also calculated based on the face value. It is 1 rupee and cents like this. Here the cents 3424 like that. Accrued interest part. Now one thing you have to keep in mind, accrued interest is calculated if the particular instrument is previously issued. What does it mean? If you are issuing a fresh issue, if you are doing a fresh issue, for example, we say debenture, your bank decides to issue a debenture, fresh debenture, the unit price is 100, not previously issued, now only you are going to issue, then you don't have accrued interest. Accrued interest comes only where previously issued. Why? Somebody should hold this particular instrument previously. Now this particular instrument, I have purchased this particular instrument on the September 2nd, 2nd of September. But somebody was holding this particular instrument before that. It was not it is not fresh issue. This is not issued, this particular treasury bond was not issued on the 2nd of September. No, 2022 second. No, it was previously somebody was holding this particular bond. Previously issued, then obviously you should have what? Accrued. We take this particular instrument, this is previously issued. Now see date of issue, 2020. This particular instrument was issued. Balance part only now issued. This particular instrument first issued in when? 2012. 2022, the balance part they are issuing. So then obviously you should have what? Somebody was holding this particular bond. Government is holding this particular bond. Now you are issuing. Now they are issuing. They are selling. They are selling it to you. They are selling it to primary dealers. Same scenario. Same logic. Similar to this particular instrument. Somebody was holding this particular instrument. Who was holding? Only the government. Has been previously issued, of course. When was that? This particular instrument 2020, this particular instrument 2012. Understood? That's that. The only thing can have to remember, when issuing a particular instrument, it may include accrued interest. The basically when you calculate the pricing, it is basically coming under dirty price. So when you ask to find out the clean price, of course you have to find out the dirty price first. Then accrued interest part. Accrued interest part is how do you find out? From the last coupon date to the settlement or the purchase date. Calculate, but take the face value, 1 unit, and multiply by coupon interest rate and the actual number of days from last coupon date to the purchase date or the new settlement date. Then that is accrued interest part, which is relevant to whom? The previous seller, not to the buyer. Understood? Right. And okay. That was the missing part under we had to complete this under issue management. That was the part I wanted to share with you. And this is also another one. And I last week also I told you. Now, if you see the treasury bill auction results, today's result, not today, yesterday's result. Uh, Treasury bill rates are increasing now. Now, this is the latest yesterday's treasury bill results. I think you can see this. Now, see the rate. 593 has gone up to 596. 590 has gone up to 595. 587 has gone up to 592. Now, this scenario is happening after the policy decisions revised. From the day the policy rates were increased, and from the next after the first option onward, after the revision of policy rates, treasury bill rates started to go up. All three tenors, 3, 6, 1 year, going up. So we are expecting further increase in treasury bill rates. So risk-free rate is increased. Now some banks are paying, some banks have been paying 1 year deposit 5%. Now they can't pay more than, they can't pay 5% anymore. The only thing treasury bill pays 5.96. This is weighted average. Of course, you get lesser yield. This is the rate primary dealers get, right? Primary dealers keep a margin and they are selling at, example, we say 590 example. So we are getting 590. Some banks are paying for fixed deposit 1 year 5%. So basically, your money will be moving to treasury bills 1 year. So obviously, what do you have to do? You have to increase your FD deposit rates. When you increase the deposit rates, of course, you'll have to increase what? Lending rate as well. So the entire country's interest rate has to be increased. So we are expecting another rate hike before end of this year. So the increasing trend also started. So I basically explained to you last week the motive of this policy rate revision, upward policy rate revision. And surprisingly, central bank has increased the SRR as SRR rate as SRR by 2% to 4%. So they have increased SRR by 2%. Presently, before the revision, it was 2% SRR. Now they have increased by 2%. So now the SRR is 4%. So anything you have this particular rupee deposit, you have to keep 4% in the central bank. Earlier, you had to keep 2%. Now you have to keep 4%. Of course, you are dying with your liquidity. If you don't have money to lend, your lending has to be curtailed. Your lending has to be curtailed. So obviously it's happening now. So central bank has taken this decision to curtail the credit growth in the country. So the expected credit growth, as I told you last week, 14%. Now it has reached to 12.9%, almost 13%. Only 1% has to increase to reach entire country's credit growth. So then there should be a rate upward. So obviously, when you have the increase the interest rate on lending, people reluctant to borrow. So that's what the motive of the central bank. So they have increased interest rate, right? And there are other factors also, but due to the exchange rate pressure only. Now for dollars, the banks paid more than the deposit rate, LKR deposit rate. It has not happened really. So obviously, rather than you converting into rupees your export proceeds, you can borrow at a lower rate when you have a lower regime of interest rate. Rupee, you can borrow at lower rate. You keep the export proceeds, the amount you received as foreign currency in the account, whereas you are paid 7% by the banks. You want any financial support, you can borrow from the banks at a very low level, 5% now. Today, now AWPL are at single digit now. Now after this revision, it has gone up to 5.94, but it was at 5.87, 5.82 like that. So the borrowing cost has drastically reduced with the low regime of interest rate. That's obvious. To curtail this credit portfolio, then you have to increase. So that's what the central bank has done. This. So central bank has. That's what the central bank did, right? Increase their policy rate. So important, right? Someone can test you the impact of increase of treasury, sorry, the policy rate, and also the SRR increase, right? Okay, right. So then we had to complete this. Now this particular advertisement, only the missing part was accrued, and now we know what accrued interest is. Okay, and this one also, and this particular question was very important. I have touched the CAPEM master, but CAPEM also coming when I do the next question. When I'm sorry, when topic the next topic, project evaluation, and this particular question is very important. Right? So we have been talking about all these 3, 6, 12, everything will go off within 1 year with regard to zero coupon. Now this particular instrument, 5 year zero coupon. So right, 5 years. That's also important, right? Just a reminder. And now remember that we discussed when you do discussion on particular investment alternative investment. Now now we discuss increase in trend of interest rate. Increase in trend of interest rate going up. There are 4 types of yield curves: going up, going down. I'll take it this one, flat, and 4 types. What is this? Yield curve. So yield curve is what? You have here the percentage of yield. You have 3, 6, 12. What are these? Treasury bill maturities. Then you have 2 year. Then you have 3 year. Then you have 4 year. You have 5 year like that. Then when you have 3 months treasury bill, how much? 6 months treasury bill, how much? 1 year. 2 year, how much? Then you put here and you draw it. Then you get curve like this, meaning what? Increase in trend of interest rate. So yield curve is rising. In the future, interest rate is tend to go up. So when you take the decision on pricing of your particular investment. Example, your products, deposit products, or the loan products. You take this into account before you take decision whether this particular current, what is the current market interest rate scenario? Is it increasing? It is decreasing? It is flat? It is variation? Based on this decision only you take this based on this only you take decision whether to you reprice upward your deposit product or bring down or keep it as it is, and based on that only you take decision on your loan products, right? Loan products are based on the yield curve, future interest rate scenario. So every day you have yield curve. Every day you have yield curve. You can draw every day. Now you know. Now before this rate revision, 5-year treasury bond was trading at 7.3 to 7.4. Now it has gone up to 8.5%. It's gone up by 5%. Now the rate has increased only by 0.5%, 50 basis points, but the rate has increased 0.5%. It can be happen. The only thing the government security market was pretty dull. Why? People who are buying this particular bonds or instrument, the investment or the investors think that future also this rate might increase. If I if if my money can be invested at 850 now, after 1 month time, if my money, same money, if I am holding this particular instrument, not investing, if I can invest my money at 9%, do you invest at 850? No, you are holding for 1 month and do the investment at 9%. Same thing happen here. There is no theory here, only the real thinking. ලබන මාස මේක 9ට යනවා නම් අද 8.50 නම් what is the big issue holding for 1 month? I can hold it for 1 month. I can hold it for 1 month. I can hold it for 1 month. Then I can invest. That's what people are doing. Another reason is, the real reason is people are more doing some investment in share market. So your money is not invested in bank products, deposit products. You do the investment in share market. Now you know share market has reached the history highest. Today is 9,000 plus. So the last 7 or 8 days, so every day you can see some ASI is increasing, all share price is increasing, right? It basically, you have what kind of market we learned? The bull market, the prices are going up. Bull market. So then we'll have a different issue is whether this actually based on the value, this pricing are going up. That's the question. But only thing it's going up. So we are within the 10 best performing share market again. Once we had the best performing share market. Now we are within the 10 best performing share markets in the world. Right? So all these shares are trading with the retailers' money. So the foreign participation is very minimum. Right? And again, you know, I want to tell you that this week, S&P has downgraded. They have already downgraded Sri Lanka, but they have downgraded our outlook. It was stable. Now they have downgraded to negative. Right? They have downgraded to negative. So that is also has impact. So if the Fitch is now reviewing, we're expecting they will not downgrade Sri Lanka again. They have done this in 2020. Now I don't see any reason to downgrade further Sri Lanka. So everybody, all the countries in the world are suffering. That's we have to accept. Right? Ups and downs are there. That's true because of this pandemic. Now we have received $780 million from IMF, and we have received 150 million from Bangladesh under the SOP, and we have received only 150. Now balance another 50 has to come, so the entire amount would be then 200. and we'll be expecting other China money to come. And also government has various methods to have to have the stabilize gross reserve ratio, reserve amount towards the year end. The government is expecting to have 7 billion again. Now we had 5.2 billion last year end, last year end. Now before we make this ISB settlement in July, we had 4. Now we have a 2.8 billion gross official reserve. Now we are expecting government expecting to have 7 billion towards the year end. With this all these alternative mechanisms. So the government is getting money, but only thing after this vaccination program, so if we can open the country for tourism, so that will be a great thing. And tourism is a 4 billion industry. So US dollar 4 billion annually we have lost. Now 2020 we didn't have, and 2021 up to now we didn't have much tourism. It's a 4 billion dollar we have been receiving from the tourism. So, but due to this pandemic, even we open the country for us ourselves. So if the pandemic is worse in other countries, of course they are coming. So the entire country has to get rid of this particular pandemic. Otherwise, very difficult to have the smooth functioning of tourism. Right. So, so I thought of before I move into the questions, so I thought of finish the balance part as well. So, and I have put some questions for you to refresh, and you can attempt this question. If there is any difficult question, we can take it in the class. Just to refresh, and I think your exam is also postponed because so I wanted to take some extra classes. That's why I have skipped it. Only thing I have not taken the last Sunday class. Now to replace the last Sunday class, I'm taking today's class. Right? There is no extra classes. So the institute has instructed not to have extra classes because they were expecting to have this exam end of October. I don't think it's possible now. So I think they will postpone your exam as well. So that's why we'll be not taking much extra classes up to now. Institute has taken a decision. So this is the replacement of the missed class, right? Last Sunday. This particular formula is important for you, and this is more important for you to have next session project appraisal. Now this is the CAPM formula, risk-free rate and beta. This is we call the one particular word is a risk premium, market risk, market yield, and the risk-free rate. So difference between market yield and the risk-free yield is the risk premium. Risk premium into beta plus risk-free rate. Add to risk-free rate, you get capital asset pricing model, the yield you get, discounting factor you get, your required rate of return you get, the discounting factor, everything is similar words, right? Depending on the situation, it can change. The name can change, but the calculation is similar. The base is very much similar to everything, right? So anything you need to ask, any question? And also I must I like to tell you now I have uploaded all these tips to you all. Wealth management, under wealth management I have covered 5 topics with you all, right? And also important role of investment banking as well. Now, shall we move on to the project appraisal part? Do you have any question on this? I'll be taking some question with you later, exam question, how the examiner has tested you on this. We can take it later. Hmm. So, any question you have? We have discussed the current scenario as well, policy rate increase. That is also important for us to know. Right, so what do you mean by project? What do you mean by project? Project is anything which gives return over the time. Project is anything which gives a return over the period. Purchasing of a machine, is it a project? Of course, it's a project. Investing in positive, is it a project? Of course, it's a project. Project is anything which gives cash flows over the period of time. So the purchasing of a vehicle, purchasing of a machine for a particular company is a project. Is a project. It gives what? Cash flows over the period of time. It gives cash flows. So you purchase it today, there is a cash outflow, and over the period of time you get what? Income plus expenses as well. Now, very similar to calculation of treasury bond pricing. Project appraisal is a very frequent question from the examiner. As we are asking regularly this question, project appraisal. So the project is anything. Now see, now types of investment decision: expansion, diversification, modernization, replacement of assets, cost reduction, anything. Purchasing an asset, purchasing a machine. Project. So how do you understand whether this project is viable or not? This is how you understand. This is how you take a decision whether this project is acceptable or not. If the NPV is positive, now you know what NPV is: net present value. Net present value. If the net present value is positive, you accept the project, go ahead with the project. If the NPV is negative, you don't accept the project. NPV, have we calculated before? Of course, we have calculated before. Where? We have calculated the NPV before. Yeah? Treasury bond calculation, remember? Net present value. Have we calculated net present value there? No, we calculate only what? Present value. We calculated only the present value. Remember? Not. We calculated only the present value. Now, what do they say now? Now they say net present value, same thing. Yes, 0, 1, 2, 3, 4. You have purchased a machine. It gives income. Example, right? 5, 5, 5, 5. Example only, right? With a 50. With a 50 income. And you have also expenses. When we do the bond calculation, we have not taken that part now. We have only taken what? Coupon interest. We have taken only the coupon interest and the maturity proceeds face value end of the period. Now here you have taken income And expenses also you have taken. We say 20 example, and can be changed, right, year on year. Expenses has to be deducted, which we not seen in the calculation of treasury bond. And this particular machine can be sold after the 5 years time. We call it scrap value. 10. Scrap value, that can be happen. Scrap value. Tumbun again. Can tell you that. Plus inflow. These are the cash inflow. Outflow. Machine. Purchasing. Purchasing of a machine. For you to purchase machine now, recall the bond calculation. What did we find? How much do you have to pay now? There is a machine here. You want to purchase. How much the machine? You know the price. When we calculate the bond, we didn't know the price. We calculated the price. Now this is a machine. You know the price. Then you don't need to calculate the price. Here you only calculate whether now this particular machine is worth 1,000. Is it worthwhile for me to pay 1,000 and take this machine? That's how you're finding out here. But when you do the bond calculation, what did you find? How much do I have to pay? You don't know this 1,000. You're finding out the 1,000 when you do the bond calculation. You know, that's the difference. Otherwise, everything is similar. Now you know the price for you to pay now. Now is 0,000. Example, with 100. Purchase price. Outflow. Now you pay 100. Then you get every year 15 comes. Plus there is also in expenses as well. 20, 20, 20, 20. And also after the period you can sell this particular asset or machine at 10. So these are the cash flows. Cash flows. Only the cash involvement has to be there. Right? So cash flows in the sense you don't take depreciation. So if you have done any accounting, you know depreciation is only a accounting entry. Provision you don't take it. Remember that, right? If the examiner gives you depreciation figure, year 2 depreciation 10. You don't take it, only the cash flows, cash terms. Only cash flowing and you take it. Don't take the provision. What do you call this? Uh, Bad debt provision you don't take. Any provision you don't take. Depreciation you don't take for the calculation of NPV. Only the cash flows you have to take it. Other costs are irrelevant. Only the relevant cost has to be taken. Now see, here 100 is minus. Here the 30 comes plus. Here 30 comes plus. Here 30 comes plus. Here the 30 and the 40. It's minus. Now see the difference when you calculate the bond and the project. Now you do what? Now you find out the discounting factor. How do you find out the discounting factor? It has many ways to find out. One thing we have learned, that is CAPM, capital asset pricing model. How do you find out the capital asset pricing model? Risk-free rate plus beta, market return minus risk-free rate. This is what risk-free rate? Treasury bill rate. Beta is anyway given. Beta is the measurement of what? Systematic. Last week we have learned. Systematic measurement of systematic risk, which cannot be diversified, which cannot be avoided. Which risk cannot be avoided? Systematic risk. So then you pay something for that. That's why beta has come there. Then by using CAPM is a one method of finding the discounting factor. But when you do the bonds, did you have a similar difficulty finding out the discount? No, this is a company. So if it is an individual, My money, is it worthwhile for me to invest in treasury bond or any other investment? That's a simple decision as an individual have to take. Now this is a company like project appraisal. Basically, you do it for companies, not for individual. Individual ඉතින් මේක හොයන්නේ නැහනේ. මේක මට වාසිද ගන්න, but you know what is your projections and you take it. Generally, individual not the individual, but the companies are taking. Now, see the methods. It's available. One thing is what? CAPM. And there are many methods by using the dividend. By using the dividend. Now, dividend valuation model is one method of finding the discounting factor or required rate of return for individual. Individual, of course, if you want, you can, but individuals are not using this dividend valuation models to find out what is their return, the what you call this rate of return, required rate of return. They don't use this. Now, think about this. If you take a company, how do you get finance from the company? The සල්ලි හම්බෙන්නේ. One thing is from the owners. How do you call that? Capital. What else? Method of raising capital. Method of raising funds. We learned that if it is what you call if it is owners, then they put what? Capital. If the owners are not willing to participate, then they go and borrow from the bank. Borrowings. That is also one method. Borrowing is also possible. Borrowing is also possible. Now, there are two things in particular company. One thing is owner's capital. If the owner's capital are not enough, then you go for borrowing. So the owner's amount, how do you call this? Capital. So the capital, does the capital have a cost? Of course. What is the cost for the capital? Dividend. Does the borrowing has the cost? Of course. What is the cost for the borrowing? Interest. So the cost of equity is dividend. Cost of borrowing is the interest. Those are the two methods. Equity and borrowing are the two methods of finding the capital for a particular company. So finding the capital in terms of owner, in terms of borrowing, both the methods have cost. Capital, dividend and the capital. I'm sorry, dividend and the interest. Now here cost of equity. Dividends are paid for whom? People who are holding the shares. So this is how you know there are few methods now under the dividend valuation model. One particular assumption, we say dividend is paid constantly similar amount every year. හැම අවුරුද්දෙම රුපියල් 2 ගානේ ගෙවනවා dividend. There can be a companies like that. No growth. There can be companies, no, today, now this year, we have made a huge profit, then we should increase the payment of dividend to our shareholders. You can do that. So the growth, with the growth, and there is another one, you continuously, you pay dividend constantly for some period, then you increase. That is also a method, but this method is not available here. There was a question in the exam. When I do the question, I will catch that question and complete that. But here I have taken only the two methods, which is not exam has not tested this one so far. These two, no growth is very easy. with the growth. Now remember the formulas. D means dividend, P is the pricing, percent price. G means the growth. You have to keep in mind the formula. This is the CAPM. This is another method of finding the required rate of return, another method of finding the discounting factor. Cost of debt. What is the difference between cost of equity and cost of debt? Only the tax rate. What do you mean by that, tax rate? How come the tax rate is different from cost of equity and cost of debt? Cost of equity, dividend. Dividend is paid after tax or before tax? Dividend is paid after tax, except preference dividend. Here we are talking about the ordinary share. Dividend is paid after the tax. So then do you need any tax calculation, tax adjustment? Interest is paid for the borrowed amount. You have borrowed from a bank, you have to pay interest to the bank. It's an expenses, finance cost. You're paying before tax or after tax? Obviously before tax. After deducting the finance cost of borrowing, after deducting the interest cost, you pay taxes. So then you have to make an adjustment to the tax. You calculate the cost of debt. 1 minus T. Remember in the exam you have to take it. It is the cost of capital, cost of debt. Please take it after the tax rate. The yield after the tax, you should adjust the tax to the cost of debt. Remember only the cost of debt. Huh? Don't do the tax adjustment. There was a question in your exam. Examiner was asking cost of equity, then they have given the criteria. One criteria is tax rate as well. You take it. Finish. Cost of preferred capital is also type of debt. I have taken that as well. So you cannot understand now. So these are the two methods: cost of equity, cost of debt. Those are the two methods of finding the capital compensation to the bank. So you can find the money to particular company by way of capital or by way of borrowing. What is the cost for equity is dividend. What is the cost for debt is interest. So that we will come back to later. Understood? Understand. Now, sources of finding the capital. One thing is equity, the other one is borrowing. Now tell me, how do you find the capital by using equity? You are a owner of this particular company. You are owner of this particular company. You are owner of the particular company. One method we discuss what? One method we discuss equity capital. One method we discuss is equity capital. So the equity capital is what? Who put? Owners. Owners put the equity. That we know. Then you pay what for that? Obviously you pay dividend for that. Now how do you raise funds? You can ask existing owners to put capital. Then you are issuing what? You are issuing what then? New shares. You are issuing new shares for you to get capital. Understood? You are issuing new shares to get the capital. That we know. If you issue new shares, what will happen? New shareholders will come into the picture. If the existing shareholders don't like new shareholders coming to the picture, then the problem arises. What will happen? When the new shareholders coming into the picture, what will happen? So your share ownership will be, what will happen to your share ownership? Will be diluted. So like, so we have learned when you're discussing rights of ordinary shareholders, preemptive right. Can you remember that? Under the preemptive right, you first offer something to the existing shareholder. You first tell when you advertise your company, your bank's or a finance company's vacancy. First, you advertise your internal customers. Who is your internal customer? Your employees. Now, under the preemptive right, you issue what? You need money. You're not going to issue new shares. You're not inviting others to come. And you are issuing new shares to whom? Existing shareholders. How do you call that? Right issue. This is the one method of finding the capital without diluting the existing shareholders. Now, right issue. This is how you do this. Right issue is what? Issuing shares to the existing shareholders at a discounted price. One for 4 shares at 15. One new share. Anybody who's holding 4 shares. Anybody who's holding 4 shares now gets one new shares at what price? 15. So the market price may be higher than 15 or less than 15. Obviously, it should be higher than 15. It should be higher than 15. So the discounted price. Now, shall we attempt this question, please? Market price is 1st July 2000. Market 1st July 210 per share. Company decided to make a rights issue at one new share at 150. So the right issue price is what? 150. Right issue price is 150. Right issue price is 150. One new share at what price? 150. Every 4 shares already held. Every 4 shares already held. After the announcement, share price fell to 195. But just prior to the, you always take the just prior to the right issue price. It has recovered 200. One new, 4 existing. New, what is the right issue price? 150. The question I was referring to, right? And before right issue, 100. Now 150 here, here 800. Total is 950. How much after the right issue? Now altogether, after the right issue, you have more number of shares. So obviously, after the right issue, your share price should come down or not. Obviously, your share price should come down. Why? You have more shares. You had 4. Now you have new shares of 1 here. So the altogether after right issue, you have 5. 4 පහලොකු. So after the rights issue, you have more number of shares. When you have more number of shares, price should come down. Why? More supply. So after the right issue, the price, we call it theoretical X right price. Theoretical X right price. Several times tested. Theoretical X right price. Altogether you have 950. Altogether how many shares? 5. So the 950 divided by 5 is your theoretical X right price. How much? Before the right issue, how was the pricing? 200. Now after the right issue, 190. You have more number of shares, obviously the price should come down. It has happened. Theoretical X right price. Theoretical X right price is very important in the exam. Examiner has several times tested this question. And please, this one, 190. Theoretical X right price. And also you can find out the value per right and the theoretical X right price minus issue price and the existing number of shares. Right? N means existing number of shares. So once you calculate this, you can have existing number of shares. And shall we attempt this question? We will take later the question papers. Now, company currently, this is the question, right? 190 was the theoretical express price. After the right issue, 190. Shares will be trading at 190. Before right issue, it was trading at 200. Now here the question, the current price is 210. Company current market price is 210 before right issue. Company wishes to make 1 for 5 rights issue. 1 for 5. 1 for 5. 1 new 1. Market price is 210. Current market price is 210. And the company wishes to make 1 for 5 right issue at discounted price as 180. Here the 180 plus plus 5 invoice. So the 1, 2, 3 divided by 6. Calculation. 205. Before the right issue it was 210. Now the after the right, the theoretical extract price is 205. So the value is 205. How do you find out the value? The examiner not tested this question. Now. This right issue price is how much? 180 divided by 5. 205 minus 180 divided by 5. 205 minus 180 divided by 5 means it's 5. Understood? And we have done this, right? So when you don't subscribe, your your shareholding is diluted. Now, shall we take an example and see how these rights are not subscribed? Your shareholding percentage is diluted. Now, say this is a number of shares. Number of shares 100. So I'm holding 20% of this. Here, 20% again. 20% I'm holding this particular 150. Go ahead. Thank you. 20 number of shares I'm holding. Right? 20 number of shares. Company decided to go for one new share every 5 existing shares. So after the rights issue, how much? How much the rights? One new share for 5. So the old together, okay, pattern in the we say one new share for every 4. So the rights, how much new rights come? Or the new rights means shares, right? 25. ඔක්කොම 100යිනේ. 1 for 4. So the ඔක්කොම 25 1 එක ෂෙයාර් එකකට හතරක් හෝල්ඩ් කරන එකට එකක් දෙනවා. So 100ක් නම් ඔක්කොම 25. After the right issue, you will be having 100 earlier before right issue. After right issue is 25. After the right issue, you will be having this when this particular company has 125 number of shares. How much am I holding? 20%. So what is my entitled? 1 for 4. My entitlement is 5 number of shares. Right? 1 for 4. හතරක් කෝල් කරන එකට එකක් දෙනවා. So 20ක් කෝල් කරනවා නම් 5යි. So what are the options available for me? මට මේක subscribe කරන්න පුළුවන්. Whatever the price base is, I can sell it. I can do nothing. I can part sell part. Okay. So that's the 4 options I can do. We have done this. You decided to subscribe. 5ක් entitlement එකක් තියෙනවා 5 ගන්නවා. So after the right issue, how much your shareholding? 20. You have 20 number of shares. CI 20% can 20. Fine it. 20 or 20 number of shares, 20% I have sold it. My shareholding 5. So I subscribe 20 plus 5. I'll be having 20. Ended up with 25. So I'm calculating now my shareholding percentage. 25 number of shares out of total 25. What's the percentage? 25 divided by 125 into 100. 20%. Okay, shareholding percentage 20%. Has something happened? Before right issue, I was holding 20%. Number of shares 20. Now, after the right issue, I am holding 20%. Same shareholding percentage, but the number of shares has increased by 5. Was 20, now 25. But I am still maintaining the same 20%. I am happy. I decided not to subscribe. I read. Right? My title is 5. I don't subscribe. I don't have money to pay. So I was holding 20%. 20 my entitle is 5. Somebody is asking me number of shares entitle. I don't have money. What to do? I can't do anything. So I can sell it. You can sell and earn something. You can sell it means you don't get. You are not subscribing. To calculate it. How many number of shares you are having now after the right issue? 20. After the right issue? 20. Why? I have not subscribed. I am holding my existing number of shares, which is 20. Company has issued 144, correct? Do you think that if you don't buy, you don't do anything? Do you think that if you don't do anything, company will not issue? Company will no. We don't do anything. Company is anyway issuing. There is one. 144. They will somehow issue that. So the end of the period after right issue, they are satisfied. They get 125 anyway. They are issuing. It doesn't matter you don't subscribe. It doesn't matter you have subscribed. It doesn't matter you sold. You sold. It doesn't matter. The entire company wise. Take it. So they will issue the entire. So calculate the percentage now. Are you maintaining the same percentage? Now you have 20 out of total number of 125. Are you maintaining the same percentage? Or less? Or more? 20 divided by 125 into 100. 16%. Am I correct? So I think 20 divided by 125 into 100 is 60. What is that? Before the right issue, you were holding 20%. And after the right issue, you were holding 60. What has happened to your shareholding? Your shareholding has been diluted. This is the dilution. So if you don't subscribe, and if you part subscribe, if you don't fully subscribe to the rights, obviously your shareholding percentage will dilute. This is how you do this. Whatever the option you take it, and you will be diluting your existing shareholder, right? So any question you have? So these are the things I just wanted to discuss with you. And next Sunday we'll be having a class. I will be continuing from there, and we will continue from project appraisal from there on, right? So then we will be moving on to foreign exchange transaction. So on Sunday we can move into foreign exchange transaction. So please feel free to inform me this method is okay for you also. So I can use the board here. If you see any visibility issue, please let us know. So we can do some adjustment to that. That is important for us to take some decisions on that, right? Any question do you have? I know it's very difficult after you coming home, after your work, and please go through anything if you can't understand. If you have any doubt areas, please let me know and we can continue. We can do the clarity. And after doing project appraisal, I before I start and in the middle of code exchange, I'll be taking some exam question with you, and I will be preparing some special question taken from the exam, and I will give you one shot. I will upload. Then you don't want to take the entire paper, so then we can do that. Huh? So, any question do you have before we wind up? Okay, then we will wind up. Thank you very much for participating. Right? Thank you. See you. Good night.